Good evening to everyone present here today. We have our product manager Jason D'Souza who will share powerful insights that will propel your investments to new heights. Towards the end, we would also be having a Q&A session. Over to you, Jason.
A very warm welcome to each and every investor gathered here today. The last financial year has been nothing less than a roller coaster for the equity investors. Right from feeling the tremors of the Russia-Ukraine war crisis towards the series of Fed rate hikes, and the latest one I can recollect is the SVB bank collapse. A lot of things have happened in the market and it's quite volatile as well. But the one thing I stand with is that these difficult times helps us think deeper. Okay, and keeping that in mind, I have curated few learnings I want to share with you all today. There are 5 broad learnings which I have actually added in this presentation, from which 2 of them are Markets Mojo specific, so as to how are the dots related, and the rest 3 are general market ones. So let's start off this disclaimer. Investment in securities is subject to market risk. Past performance should not be construed as a guarantee for future returns. Now, I'll start off with the learnings one by one. The first one, which I think whenever we come for webinar events, we often make this particular statement about non-linear returns in the equity market. And I don't want to bore you all today, but this particular learning, I'm giving you all a different perspective about it. What I mean by non-linearity in the equity market or non-linear returns in the equity market. Unlike fixed income products, a lot of investors say that, मैं FD में पैसा डालता रहा, so I could have made more return. But unlike these fixed income products, the equity market moves in a very non-linear fashion. What do I mean by that? Let me give you a practical example. Now, if you had invested 100 in the equity market, here I'll take BSE 500 for an example, and the debt fund. I've taken the top corporate debt, bond fund. Okay, it's one of the top funds, so not a basic one. It's a top debt fund. And now you can see in this particular period, as you invest 100 rupees in the equity market, okay, the first year your value goes to 97, so it's actually going downwards. And then it increases to 104, and then it goes to 122. When you reach 2020 and you see this 122 rupees out of your 100 versus the 124 you could have made easily in the debt market, there's one thing which comes up to your mind, which means there's so much volatility in the equity market and hardly any returns. You might think it's the time to exit over here. Okay, this particular phase. And 2020 is one time, okay, towards Feb and March, where a lot of investors exited and lost a lot of money. At that particular point of time in 2020, you might say, you know what, fixed income is much better. Okay, you're in the equity market, it's going all over the place, but you would regret the next year itself. Okay, because in 2021, that outperformance which would happen in the equity class versus other asset classes would make up for all the lag you faced when investing. You can see that 122 has straight away become 159, you've crossed that, and then it's become 164 in 2022. This is a practical example of how your 100 rupees invested would move, okay, in a non-linear fashion versus debt, which is simply getting a 7 or 6% return year on year. That comes to my point that there will be times in the market where it provides negative returns. Being patient and following the trend will ensure these negative returns are offset by outperformance relative to other asset classes like real estate, fixed income, or name any of it. Okay, but it's your choice of being persistent inside the equity asset class itself, regardless whether it's linear or non-linear. Now, giving you this learning in a different lens. Okay, what I've done is I have actually looked at if you had invested 1 lakh in the equity market over the years across different periods. Okay, let's say 2014, 15, 16, 17, 18, 19, 20. Across different periods, if you had invested in the equity market, this is the BSE 500 index and the return. And now you can see how your 1 lakh increases across different periods. So if you had invested 1 lakh, at the end of 2015, it would become 136. Over here, it would have become 2,91,542. But let's ignore this above part of the table. I want you all to focus on these 2 things. The total return you made and the CAGR component. Okay, many of us must have entered year. I know a lot of investors in Markets Mojo who have also entered year on 2020. Okay. If you look at the total return and the CAGR, there are some observations. One thing about the CAGR which I have found out is that at times when you enter later or let's say enter before, your CAGR might be different. Okay, the returns you make in the short run might actually be different. For example, look at 2018, this investor who has entered now, he has made an 8.2% CAGR versus someone who's entered just after COVID has made a 12.1%. Now, many of us actually get dejected over here saying that, you know what, I should have entered later in the equity market. Oh, I should have entered much before. I don't know why should I enter at 2018, for example. You need to understand, a lot of advisors also do this, you need to understand that you should also compare your portfolio with someone who's entered in the same period. Don't be dejected if someone who's entered very late, is actually getting better returns at that point of time. It's a non-linear fashion. You can't expect, it to just move in a linear method. Another observation, if you see, is that over the long term, your returns in the equity market comes close to 12%. Okay, it comes close to 12%. Nifty over the longer period, okay, what I'm talking about is 15 to 20 years, has also compounded at around 12%. Over the long period, your returns will slowly start coming towards 12% if you follow a passive approach. What I mean by this is that now just because you've entered in one particular year and you've got 30% in the equity market or 40, 50% in the equity market, that could be possible. But you have to understand that over the long run, things even out and things might average out. You might also get returns closer to the index. But if this past period of excess returns you must have seen during COVID or you must have seen during a mega bull run, this should not cloud your expectations about the future. Okay, we'll come back to reality. If you see the index growing at 12% year on year, and if you mimic this index, you can't expect big surprises. Okay, but over the period of time, the point I'm trying to make over here is your returns, if you follow the index, comes close to around 12%. These are the two observations I got. Moving on, after this learning number 1, we talk about learning 2. And I've written the curse of cash calls. Okay, I've used a harsh word over here, but I think this word actually makes sense. What exactly is this cash calls I'm talking about is when you make a decision in the equity market to liquidate all your holdings and completely exit from the equity stocks you hold. What I'm doing here is that I've plotted the last financial year trend of BSE 500. Okay, just the last 12 to 13 months of BSE 500. Okay. Now, what I'm trying to find out over here is that what are these downturns we've seen in the market? Okay, what are these peaks we've seen? Why is the market being so flat over this 1 year period? If you see the market has been flatter, it has moved in this one range. It's not moved extremely downwards or it's not gone upwards. It's a flat range. I have identified some times in the market when the market has cracked and started falling down. And I wanted to find out how fast does it take to recover and what's the maximum fall you can face. If you see the first fall which happened back here in 5th April 2022. Okay. If you had invested at the top of the cycle, your maximum fall could come as high as minus 19%. Now, you might be a risk-averse investor. Okay, you might be someone who doesn't like these downward turns. You might like the bullish trend itself. But understand the market has also fallen by minus 19% from its high. Okay, if you're invested at the peak, okay, at 5th April 2022, if you had invested at the peak, you would have seen a 19% fall till the end of the cycle. But you see, on 17th August, after 134 days, it actually recovered and came back to this price. Okay, so 134-day recovery. Let's take another part of the cycle. 13th September, just after that, again, it fell and the maximum drop it saw was some 7%. And it again recovered on 14th November. A 62-day period again. Okay, but now, unfortunately, from this 1st December high, the market has been on a downward trend and it has corrected. Okay, if you know from Jan, the Indian indices has been one of the worst performers globally. Okay, in 2022, the Indian indices did well, but now if you compare it globally from Jan 23, the market is moving downwards. The maximum fall we've seen is 11%. Okay, and till date, it's still 120 days and running. We've not seen the recovery. We've not gone back to that 1st December high level. Okay, so I don't know how many days will it take to recover. But the point I'm trying to make here is that whenever you take a cash call and you say, you know what, enough of the equity market, let me exit completely. Whenever you make that particular statement, the bullish trend which would come and pick up the index, you're going to miss out on that. Okay, classic example, I think back in September 2022 itself, one of the client actually, was extremely sad and he completely exited from the equity market. And, he said that the equity market is not for me. Unfortunately, the next week itself, there was a massive bull run. Okay, that 1 week, he would have completely recovered everything. But when you take a cash call in the market and you've lost hopes over there, you have to understand that the market will bounce back. And I'm talking about a 134-day recovery period over here. We talk about investing in the equity market for 5 years, 7 years. If you can't stomach a 134 days of seeing your portfolio below your invested amount, the equity market might not be meant for you. Okay, it's like 134 days, it's like 1/3 of a year, and we talk about 5 years. So 1/15 of your investment period, you're actually below. You should not be upset over there. Taking a cash call will, reduce your return potential and will also delay your investment goals. So keep these cash calls aside. This is one clear thing we've learned in 2022. The market might fall. Your investments might go below your amount you expected it to be. Okay, as low as 19%, but the recovery will be strong and it will bounce back. Now I'll talk about the learning, learning number 3. And now I'm coming to the site. I've spoken about something which is equity market or all over the place, but now I'm coming straight to the site. Risky valuation companies are a no-no. I don't know if you all have ever seen a company tagged as a risky valued company. Now what we do in Markets Mojo is that we have a valuation dot or a valuation parameter which goes into scoring a stock. We have quality valuation, financial trend, and technicals. Now within valuation, we see the attractiveness of the company. Is it very attractive? Is it fair? Is it expensive? Very expensive. There is a risky valuation tag as well. I don't know if many investors have actually seen that tag. We categorize companies that have negative operating profits, which are considered risky. Okay, now it might get a slightly technical, but I'll get you all there. Actually, I'll take it on the site and show you all one example of a company, for example, which has a risky valuation. Okay, I'm going to Zomato. You see quality valuation. In valuation itself, sometimes you might find, okay, this company has negative operating profits. The valuation itself is risky in nature. Okay, you can see valuation risky for Zomato. But coming back, what do I mean by this risky companies? If you take the example of a P&L statement of any company. Okay, let's go back to how a company accounts for its statements. You can see sales at the top of it, the revenue the company earns, minus the operating expense, which is the first part of the expense, which leads you to operating profit. You minus the interest, tax, and finally you come to the net profit of the company. Now, it can be possible that the company is a loss-making company, so the profits itself is negative. That's fine. But when this portion, your operating profit itself is negative, that's a risky alarm for a company. And let me explain to you why. You are actually spending more than getting money into the business. Okay, if it's negative profits, that's fine. But if you're actually getting negative operating profits at right at the top of your balance sheet, if you're actually having a negative statement over there, that's when we keep these companies aside just to safeguard our investors. Now I'll go back to the stats again. A negative operating profit reflects the company's operating expense overall, always its revenues. Okay, and cost reduction, business optimization, all of this would take time for the company. So we tag these companies as risky. Now you have to understand, for this company to become profitable, it has to first become profitable year. We don't know how long. Okay, for example, let's take Zomato. For it to actually become profitable, it has to get its operating profit profitable first, then pays interest and taxes, and finally it might have some profits, okay, to distribute to its shareholders. The reason I say it's a no-no, let's see how did these risky valuation companies perform in the previous year. What I did is I went back to 1st April 2022 last year and I checked all the dots for all the companies. And one trend I found out, if the company has a risky valuation, there were 46 companies from which 10 of these companies fell more than 50%. Massive wealth erosion. We had 16 companies falling -20 to -50, 9 of them 0 to -20, and few of them did comparatively well. But you can see massive wealth erosion. Most of the companies which fell -50%, okay, this set is of BSE 500 itself. Okay, this set of this companies is BSE 500. I forgot to mention it over here. But if you see, around 10 of these companies have fallen more than -50% of massive wealth erosion. Okay, some example of these companies: Future Retail, Dhani Services, Coffee Day Enterprise, SpiceJet, Vodafone, Omax, Godrej Properties. These all are risky valued companies. In case you have opened your portfolio tracker, okay, I'll actually take you all over there. So if you don't know, if you go to portfolio and go to portfolio tracker, when you reach your particular portfolio, you can see the dots. You can click on Mojo, and you can also sort down on valuation. In case you have any company which is tagged risky, I think it's a straight exit from your particular portfolio, because these companies don't have negative operating profits. It might take long time for them to turn around. Okay, and it's a higher probability. You can see in the last financial year, 10 of them have seriously destroyed wealth of investors. So risky valuation companies are a straight no for your portfolio. Okay, moving on to learning number 4, and I'm spending a bit more time on this particular learning because the last financial year, if you look at the amount of news articles, the flow of news and the way it has affected market. Whenever a news article is released, okay, the investors look into that particular article and try to make their particular judgments. At times, it's possible that people have overly reacted to these news articles, which might cause some market inefficiency. To break it down in simple terms, if let's say there's a negative news about a particular sector, those stocks of that particular sector start falling. But at times, they might fall too much, and that leads to an opportunity for you all to enter. But recognizing those inefficiencies are quite difficult in the market. That's why I've said you should differentiate between news and noise. Okay, if there's a particular article, see, you all have to understand from the media house perspective itself, they want clicks. Whenever they come out with a headline, whenever they come out with a news article, they will make it sound like larger than ever. Okay, they'll make it sound like it's the end of the world. And that's so that you click to that particular news article, you visit that page. You have to understand from their perspective itself. But when that news article comes, understand you should differentiate it between news and noise. Ask these 3 simple questions when you read a particular article. Does the news result in a fundamental shift in the growth narrative of a particular sector or company? Has the market already accounted for the news? This is very important. Okay, this one particular line is very important. Has the market already expected that news? Okay, is the market overreacting to that news? Okay, ask these 3 simple questions. Okay, and the reason I'm put this particular learning as, in this particular presentation is it's quite important. I've seen investors panic, completely sell out a particular stock just because of one small news which was released last year. Let's give you, some examples. Okay, I've taken 4 different headlines. Okay, 4 different big news articles which has happened this year. And let's look at them one by one. Let's understand the short-term impact it can have and the long-term impact it can have. I've written yes, no over here, but I'll take you across that in the next slides as well. We had series of Fed rate hikes, a lot of news articles. The Russia-Ukraine war, where we still get a lot of articles on this. We had the 100 lakh crore infra push during the budget. And the most recent one was the SVB bank collapse. Let's start off with the first one. Okay. Series of Fed rate hikes. Now, in the short term, these rate hikes and Sensex in the short term, we've seen that the movement is not that connected. Okay, every decline in the Sensex cannot be entirely attributed to the Fed's rate hike. If you see the last 25 basis rate hike, the market had not reacted in a very negative manner. Even before that, when we had a 25 basis rate hike, there was some disconnect with Sensex. In the long term as well, there is some decoupling visible. Indian indices are no longer moving in sync with these rate hikes. And the reason for that is now these rate hikes are already discounted and they are now part of our system. Market is not placing a high value on them. Another plus point from our end is this Indian banking sector, on the other hand, has proved to be extremely resilient. Understand, when tomorrow the Fed rates the hike, okay, he hikes the rate, you have to understand whether the market has already discounted the news. A lot of time when we get a particular news article, if the market expects a 25 basis rate hike and the Fed delivers a 25 basis rate hike, you don't have to be worried, oh God, the hikes, no, the rates are hiked, so let's now exit. That's not the case. Some things are already discounted in the market. And things like these rate hikes don't have a major impact in the market anymore compared to what it had in the beginning of it. Okay. Second article, let's get some more clarity. Okay, Russia-Ukraine war. Back in Feb, when this particular news was released, we had a severe correction in the indices. The market corrected severely. But if you see nowadays, very few people are actually discussing about this Russia-Ukraine war problem. How many articles are you seeing? You're seeing one-off articles where, some particular bombardment has happened in one particular state, so on and so forth. But few people are actually discussing this problem nowadays. much of the bad news has been discounted in the market today. Okay, the bad news has been discounted. On the other hand, if any good news and signs of peace, this will undoubtedly contribute to a smart rally. Again, it's a news article. It has some negative, intent with it. But all of that, most of it, 90% of it, according to me, has already been discounted in the market. Unless something very extreme happens, you would see a fall due to the Russia-Ukraine war. On the other hand, any good news now, which is not currently expected, but if there's any good news, that will push for a smarter rally in the equity market. The third article, the 100 lakh crore infra push by the market. Now, if you see, as soon as this news was announced in the budget, in the short term, Nifty infra did not exhibit any movement in the market. If you see Nifty infra, if I just take you to the site, okay, how did I get this data? If you go to markets today, and let's go to sectoral indices. We're talking about the infra. So I'll just click on all sectoral indices. Okay, I'll click on Nifty infra. I think around 1st Feb when the new budget was announced. Okay, I'll just select 1 year period, sorry. Yeah. Yeah. So around 1st Feb when the news was announced over here, you can see 5050 range. Today it's around the same range. It's gone little up, little down, but it's around the same range. In the short term, this has not made any particular impact. But in the long run, it would make an impact. Okay, this news has released. You might rush and buy infra companies, but you have to understand which companies will benefit and how the allocated budget will be utilized. Simply because this news has come out, I had seen a lot of investors, we have a lot of mutual funds as well, which specialize in investing in infra companies. A lot of investors rushing to buy that. Now, one particular company or the other particular company in the infra space itself might move in different directions basis the amount which gets utilized by them. This news article should not be consumed straight at its face value. Understand, over the long run, this 100 lakh crore will be utilized. You will have to identify which company might get that particular benefit and then invest accordingly. Okay, so in this case, you can see short term में कुछ impact नहीं हुआ है, long term में impact हो जाएगा. Okay, as this money is utilized. The fourth and the last particular article is this classic SVB bank crisis. This news in the near term did cause some panic and fueled a downward trend, especially in the IT sector, which does have a large proportion of business in US. Now understand, when this news article comes, instead of just simply holding your head and saying, oh God, you should ask yourself, now what? Okay, SVB bank has collapsed. Okay, now what? This bank, okay, now it's a banking space in the US. Okay. Is any particular Indian company related? Okay, there's the IT sector is related to this particular thing. That's great. Within IT sector, which company has most of its operation in US? That's how you have to ask yourself the questions. Not just SVB bank crisis has come and hold your head. That's not the way. Now what? You should break it down a bit more in depth and go a bit deeper to get the real idea. What happens in the market is when this particular news comes out, everyone sells stocks, everyone liquidates. That's when you can enter in stocks which have been battered down more than what they should have been. Now, in the long term, the indicators do not indicate any slowdown. The economy story has not changed, and it is substantially stronger than 2008. Understand, in 2008, the Indian banking system could have, easily collapsed. Today, it's in a much stronger position. The way the RBI is monitoring, the way the banks are performing, it's in a much stronger position. So straight collapse won't have a major impact. Okay, we'll have to give it some time as well. But I personally feel 6 months down the line, very few people will be talking about this topic. It will be not much of interest unless there's a major shift and there's some big problem, systemic problem in the banking system. That's when something can happen. But I'll tell you, not even 6 months, I think in the next 3 months, many of us won't be discussing about the SVB bank crisis. Okay, news when it comes in, you should ask yourself, now what? Go a bit deeper with it, and it should not affect your entire mentality. Okay, people over-exaggerate. The media houses always over-exaggerate. This one classic learning in FY23 is to not overreact with every news article. Okay, moving on, we have learning number 5, which is again now a markets mojo specific learning. In turbulent times, okay, like the last financial year, quality should be priority. Okay, If it's not a very risky time, not a very volatile time, you might take some risk and invest in below average companies. When I say quality is priority, I'm talking about the quality dot of a stock. Let me take you all back to the site and give you an example. I'm just clicking Siemens over here. We have these 4 dots. The first one itself over here, quality. Okay. Quality is priority, and why? Let me explain one by one. In the past year, 21 BSE 500 companies plummeted more than 50%. One thing remains consistent is the poor quality dot. Here we must understand this quality acts as a gatekeeper. These potential turnaround stocks, okay, companies which are below average quality, have not shown excellent returns previously, have not shown excellent performance, they can be tempting. Okay, they can look tempting, but in these turbulent times when the market is very choppy, avoid these poor average quality stocks. Someone asked me that day, how do you identify a value buy and a value trap in the latest event? Look at the quality dot. Okay, you can actually distinguish if a company is very attractive, that's fine. Look at the quality dot. Is it excellent and good, or is it below average? And the last statement, quality might not pick all the winners, but the stock it selects would have a greater proportion of winners and fewer losers. Let me show you all with some data. I think that will clear you all out. Past year 21 companies. 13 companies were below average. 5 of them were average. Only 2 of them were good. I'm not saying, all good quality companies will do extremely well. There were some of them which fell minus 50%. But my point here is that 18 out of the 21 were below average or average. These are some of the examples. TV18, Take Solutions, India Bulls, Lux, Indostar Capital, and Laurus Labs as well. You see, quality is not judgmental. There was once upon a time when Laurus Labs was a good quality company. Okay? If the performance is bad, if the company's fundamentals change over time, we will mark this company as a low quality company. Okay, so the quality of Laurus Labs also did undergo some change. So many of you all might be confused that, Laurus Labs once upon a time was an extremely good company. But I think the quality also changed for this particular company, and at times it can also fall. Okay, but my point here is that in turbulent times, quality of a stock is top priority. Okay, don't compromise on the quality. It might be below average, but I think it's a turnaround story. At least in this last fiscal year, the way the market is being very volatile, the market will completely trash a company, okay, if the fundamentals don't look good. Now, these were the 5 learnings which were, some of them were on the site or some of them were on, market specific. But there are 2 of the learnings which I just picked out from my webinar as well. Okay, let's go through some crucial takeaways which I have actually done in the last few months, which might come handy to you, especially after this current market. The first one is using the portfolio tracker to manage your risk. I've done a lot of events on your risk, on, explaining you how you can understand your risk summary. This card on the right is one particular card on the portfolio tracker section. It helps you understand the volatility of your portfolio. I won't spend much time on all of this. Are the returns you're taking justified basis the amount of risk you're undertaking? You should also look at your market cap allocation and something like VAR, which is value at risk. At any particular point of time, there could be a minimum possibility of losing more than a big certain amount. Let me take you to the portfolio tracker and show you where this is available. I'll just spend a few minutes over here. Okay, as you go, I clicked on that blue dot and you see risk over here. This is that particular dot I'm talking about. What's the volatility of your portfolio? Is it moving in line with the Sensex? Low risk, low return. Ideally, this should be low risk and high return. So you can also check this. And how to check this? Just simply go on the right. And you can see each of them. 24% of my portfolio is allocated to small and micro caps, if I'm comfortable with that. And lastly, the portfolio VAR, which is value at risk. There could be a possibility of me losing 8.98 lakhs on any single day. Am I comfortable with that? Look at this amount, every one of you all, when you all go back to your portfolio, are you all comfortable with that amount? Okay. I've also done an extensive webinar on de-risking your portfolio. Okay, this is available on the webinar section. Whereas when you go and check the risk of each stocks in your portfolio. So here you can see, if I just scroll down on beta, I can see Dynacon system, which I have, has a very high beta. Persistent Systems has 1.37. So if you all want to know how to de-risk your portfolio using the tracker, I've done a particular event on that. I'll not spend much time, but this was a very big learning for financial year 23. Many of the investors Many of my friends who started investing during COVID. Now, if you in the investor world, if you ask anyone around when did you start investing, many of them will say I just started investing after COVID. We won't blame them here because that was the time when the entire share market industry saw some big growth. But these COVID investors, I'm sorry to call them COVID investors, but those investors which started investing during that period of time, they've seen only a bullish market. They've never checked their risk because they think when you invest in the equity market, all you can see is returns, returns, and returns. Last financial year was a check for them. It was an actual check on how the equity market works. Few of the investors actually went back and saw their risk. If you've not seen the risk your portfolio is actually giving, please have a look at that because you might be taking too much risk and getting very little returns. Okay, and the last one, which was having an apple to apple comparison as an equity investor. Okay, stop just looking simply at Nifty, stop just looking simply at Sensex. What I mean by this is the first one which I marked as mirage-like situation. Let me take you to the market section to explain what I meant by this mirage-like situation. Mirage is something which, you perceive it's there. Let's say in the desert when you see a mirage, you perceive there is water. As you walk closer to the water, it's just sand. And this just happening because there's some reflection of the sun. Okay. But mirage-like situation is when, if you see the last 1 year, if you see BSE 500, for example, it's only down by 2.26%. And many of you all might tell, yeah, if the market is, flat, minus 2.26%, not seen a major down, why are my stocks down? That's when we always look at the advanced decline ratio. Even though it's just minus 2% down, many more stocks have fallen. Around 300 out of 500 stocks have fallen. Okay, so when you actually see the market gain, now for example, let's look at last 1 day's gain. Okay, let's look at Sensex. Okay, now the index is up by 1.78%. It could be possible that only few stocks have risen, but here you can see, okay, 26 stocks have advanced out of the 30 stocks in Sensex. So it's a pure movement in the index. But if you see in the last 1 year period, for example, okay, Sensex is flat. Okay, 0.72% here, 60 and 40. So here is very well divided, but in BSE 500 you'll get a better idea. Okay, you can see 290 stocks have actually declined. So it's a mirage-like situation. It looks like a flat market, but it's a bearish market. The last one is also the market cap breakdown. I've seen a lot of investors who invested heavily in large cap and then get very upset when their portfolio, doesn't see massive bounce back. Or I've seen investors who invest heavily in small cap stocks and then they say, my returns is very different from Nifty. Benchmark your portfolio, compare it with the composite index. I've also done a lot of events on what is this composite index. What we do in the composite index is that we look at your portfolio. Let's say Mr. Ajay has invested so much in large cap, so much in mid cap, so much in small cap. We will invest that same amount, okay, in large cap index, BSE mid cap index, BSE small cap index, and give you something to compare with. What happens is that you see your portfolio going up very high, let's say by 10% in last 1 year, and then you look at Nifty and say, Nifty to 2% ही दिया, मेरे portfolio ने 10% दिया है. Have you compared your returns with the small cap index? Basis the proportion you've invested. That's when you should use the composite index. So these were the two learnings which, I had actually given to investors over the past year. I thought I'll have a recap of them. Okay. I think we've covered, a lot of it. And just before I end, we do have a special offer for the webinar attendees, 26,999 for 2 years plus 3 months. Okay, with that, I'd like to open the floor for the Q&A session. Ask me any of the questions you'll have on your equity investment journey.
The first question for today is from Mr. Poonawala. I'm a long-term investor. Your Mojo stocks are for long-term or short-term, or there is two different types of stock. Please clarify.
Okay, so by long-term, do you mean that you're interested to be in the equity market for 5 to 7 years? If that's the case, so 3 to 5 years, let's see that if that's the case, it's good. Now, in Mojo stocks, what happens is that we see a lot of stocks entering the list, and some of the stocks might also exit the list very quickly. When I say exit the list, the score goes below 70, so they move out of the list. That does not mean you have to sell that particular stock. It's still in the hold category. Okay, I've also done events, so how to identify a weak hold versus how to identify a strong hold. But we'll get to that some other time. Don't get confused between long-term investment and long-term stock picking. What I mean by that is if we enter a Mojo stock and let's say for the next 3 or 4 months that particular Mojo stock is not doing well, we will exit from that stock. We will not exit from the entire equity market. Okay, so when we say long term, there can be stocks which enter for like say 2-3 months period and exit. Some stocks might remain in the list for like say 1 year or 2 year. But if we feel that that particular stock we've selected, let's say even in stock of the month, there has been times when you exit a stock, a bit early as well. If that particular stock has no potential anymore, we've realized we make a mistake, that stock might exit that particular list. Okay, so long term is for your entire equity investments. Mojo stocks can be short, mid, or even long term in nature.
The next question is from Mr. Tiwari. Which sector can be bullish in the coming year?
Bullish in the coming year, I have opinions on few sectors as well. I personally feel capital goods and infra. In one of my recent events also I said capital goods and infra. The 1 lakh crore infra push, as these projects get started, the gestation period gets over. As we identify companies in the capital goods sector which might do well in this particular period. That's one sector I have my hand on. I also find the pharma looking good. Okay, there has been an announcement from today itself, 1st April itself, some of the scheduled drugs have seen a price increase. Okay, and I think scheduled drugs has 20% of the revenue of the pharma sector. So that would be a big push for their revenues. So my personal opinion, I feel the capital goods, the capital goods in the pharma sector looks a bit good for me.
The next question is from Mr. Vivek. Can you suggest screener ideas to avoid choppiness in the market and provide stability to the portfolio?
Okay, so choppiness in the market is very difficult to avoid. I mean, when you diversify your portfolio, you can get rid of unsystematic risk, but that systematic risk in the market is very difficult. You will find choppiness. But let me just share my screen and take you across it. So I'll go to the screener section. If you just share my screen, I'll go to professional, make your own screener. Okay, if you want stability and actually pick companies that might not fall extremely in this market, you have to go for value stocks. Okay, what I mean by value stocks is you look at very attractive and attractive companies. Okay, this is just one of the filters. The reason I added this filter is that they are trading cheaper, or let's say more attractive compared to its peers. So if there's a downward trend, these companies might not fall as high as very expensive companies. Okay, so this is one safe filter you can add. Okay, but I'm not done there. We'll also add quality, which is, let's say, excellent and good. So we are avoiding value traps over here. There might be some companies which are cheap because they are cheap in nature. So just because the company's valuation is attractive, that does not mean you should go and buy. Add the quality dot because it's a gatekeeper for your stock picking. Another one which you should add, which you should go to valuation factors, and this is something which I personally give more prominence to in this particular time, is dividend yield. The reason for that is that in such an uncertain market, if you have some certain type of income, let's say some certain type of income flow like a dividend, okay, it helps your portfolio. Because you might not expect your capital appreciation to kick in. But if that company is releasing dividends on a quarterly basis, on an annual basis, it does provide some push to your portfolio returns. So I'll select companies which have dividend yield 3% and more. Let's keep it at 2% and more. Another one is selecting companies which are debt-free in nature. The reason for that is at such a high interest rate regime, companies that have high debt in their portfolio will have lower profitability. Okay, because they'll have to pay on these interest payments. The interest rates are high. The amount of money which goes out, is higher. So simply go to net debt equity and keep this ratio 0 and low. Now I have 36 stocks. Now let me run the analysis for these stocks. Now these stocks which are right now printed on the screen, okay, the quality is good, valuation is attractive. They're debt-free companies and they also have a high dividend yield component. To be on the safer side, ideally add another filter excluding bearish companies. So we'll select sideways, mildly bullish and bullish. So now we only have 14 companies on the list. The reason I selected these technical parameters is so that you're not picking a falling knife. There might be some factors apart from these dots which might pull the stock down. Let's get rid of them. Okay, but these are the companies you could say which have some which could add some stability in your portfolio. Now, before adding these stocks, understand, if you add a very small micro cap, your portfolio won't become stable. So let's look at the large company. Let's look at HCL Tech. Let's look at Bajaj Auto, Tech Mahindra, Petronet. I'm just opening these stocks. Now, you can go to, I think, returns. Yeah, this is a low risk, low return company. Okay, the volatility. It's a medium beta stock. Don't pick a high beta stock. You want stability in your portfolio, so this is a medium beta stock. Let's go to the next one, which is Bajaj Auto. It's a large cap, high dividend yield company. Low beta stock again. So as per your question, these stocks, okay, there's a 0.56 beta. So if you want to add stability in your portfolio, you should consider, let's say, a screener like this. Okay, the video will be available. So if you want to view it later, you can actually view it later. So this is something if you want stability in your portfolio.
The next question is from Mr. Srinivasa. What is the outlook for chemical stocks in this financial year?
Chemical stocks in this financial year, I'm not really that updated with the outlook of the chemical stocks. I think this is one question which our Chief Investment Officer will be really able to explain. I'm not really that updated. If I just look at the Modo list as well, I don't think there are many chemical stocks. There might be, I think, one itself. Okay. Last what I remember is when our Chief Investment Officer was not that bullish on this particular sector. So I'll not be able to give you a fair answer on this one.
The next question is from Mr. Ketan. Please let me know the best Nifty ETF fund's name.
So there's, so if you see let me actually take you to the website. Just give me a second. I'll just search some of the ETFs in the Nifty space. So if you understand, the ETF is something which is, here you don't hunt for returns. You will have to hunt the ETF which is most closer to the index. Okay, if you just share my screen. Yeah, here you can see HDFC Nifty 50 ETF. There's Mirai Asset, UTI. You can go with this first one. Now understand, if you're investing in an ETF scheme, especially Nifty 50 ETF, your returns has to be in line with that particular index. Okay, so best one is the one which gives you the least tracking error. The tracking error is nothing but the difference in that daily return of Nifty and the ETF. Select the fund which has the lowest tracking error. Okay, and its return should be in line with Nifty. So just because one ETF is giving you more return than Nifty, don't run for that one. Understand, over the long run, all of these ETFs in the Nifty 50 space will give you very similar return. So you don't have to put a lot of thinking in this. Select the fund with the lower tracking error. See, if you ask me a question like, can you give me the best mutual fund in the large cap or the large and mid cap segment? That's when, that's an active stock picking process. So you'll have to spend some time in thinking. But if it's an ETF, just simply go straight forward to the one with the lowest tracking error.
The next question is from Mr. Tarun. What should be the liquidity of the stock, especially small cap stocks and penny stocks, so that we can easily sell them if they don't perform well?
I think this question I had picked it up yesterday in our event. So Chief Investment Officer Mr. Sunil Daman has actually given a reply to that. I think you should actually listen to his reply. It's much more better. If you go to the YouTube page and just search his video, we've answered the exact same question, sir. Okay, but you're right, small cap and penny stocks, they do have some liquidity problems. Okay, when you add these stocks in your portfolio, so let me take you to the tracker. Instead of actually thinking much, we've done this job for you. If you go to the tracker and you click on liquidity. Okay, so I don't have any liquidity issues right now in my portfolio. Okay, so none of my portfolio stock seems to have a liquidity issues. But what we mean by here is that we check the volumes, okay, then the delivery volumes, and we see the amount of quantity you hold. Okay, so if you click on liquidity analysis detail, it explains to you what happens here. But if we see the amount of quantity you hold, and then we see the daily average, the 20-day average, okay, and if your quantity you're holding is substantially higher than the daily average movement, we say there's a liquidity risk in your portfolio. I don't know the sweet spot or the sweet exact amount, but our investment officers clearly explain that particular one. Just go on YouTube and you can just search on yesterday's particular event, and he has given its equity outlook event. He's given a clear explanation on that.
The next question is from Mr. Rajan. You compare the portfolio returns with BSE 500, but portfolios does not have all the 500 stocks of BSE 500. Then how it is right to compare returns of portfolio with BSE 500 index? Ideally, shouldn't it be compared stock to stock instead of index?
No, I don't get your point of stock to stock. Okay, let's say, for example, you've invested in ITC. You're saying compare ITC with ITC itself. I mean, there's no comparison. You're asking me to compare ITC with, let's say, a competitor like Godfrey Phillips. So what do you mean by stock to stock? Also write that in the chat box, because I didn't get the latter part of the question. The reason why we take BSE 500 is that the stocks, the style of the picking or the investment universe, okay, consists of stocks very similar to BSE 500. Okay, so we have to come to some certain ground. What happens is that when you pick up only big large cap companies, mega cap companies, then we compare it with, let's say, Sensex and Nifty. Okay, because it is a similar risk movement, similar trading behavior, similar returns. When you select large companies, you can go to BSE 100, then there's BSE 200. BSE 500 consists of a good mix with large, mid and small cap companies. Okay, so top 500 companies by market cap. That's why we use BSE 500, because the style of picking is very similar to BSE 500. So when you say stock to stock, I don't get your point, because I can't compare ITC with just, a very similar stock peer or ITC itself. You'll never get a stock which is exactly similar to another stock. There's hardly any few comparisons. So if you could give me an explanation of what that means, then I think I'll be able to answer your question as well.
The next question is from Mr. Sonder. I want to know, what do you mean by markets? You said market discounts this news, etc. Who is the market? Isn't market means we investors, FIIs, DIIs, regulators, etc.?
All
Please
of them.
Clarify.
Yeah, so sorry, all of them. So when I say market, I mean market participants. It's a good question, because the way you've asked it, it could be possible. So you have to understand the floating share of a company. So there's one particular very, very small company, and let's say most of its shares are held by the promoters, and there's hardly any shares for retail investors. Now, if there's a very bad news to that company, how much trading can happen should also be kept in consideration, because most of that floating is not there in that particular company for a very small company, for example. When you say very big companies, let's say, for example, TCS, Infosys, which have a large amount of floating, with these particular companies, it will really be discounted quickly, because they are large cap known in the market. But what I mean by market is all of us, retail investors, how they're reacting, how our FIIs reacting, okay, how are the mutual funds reacting as well. Market means all of us. And the way we discount news is quite different. So if you see a retail investor, how he reacts to news, versus, let's say, an FII, how he reacts to news, versus, let's say, a DII, how they react to news, it's quite different. Okay, and there are reasons why it's different. An FI has to be answerable to their portfolio. They are heads over there. They need to generate returns for themselves. So the way they react to news could be different to how we retail investors also react to news. And the consortium of them, that the entire circle of it is the entire market which discounts this news.
The next question is from Mr. Vijay. What will be the effects of rising COVID cases on the market?
So this particular news is not, completely taken into consideration. Okay, there is a healthy number of cases which are on the rise. We will actually have to give this particular thing some more time to understand. Okay, we will have to actually understand, because see, when does the market get jittery is when lockdowns are announced, is when economic activity comes to a halt. If you see currently, if the cases rise to a very high extent and we start seeing state bodies locking down particular places, that's when the impact will come in. You should not overly react to this, because the market itself, you see the last 2 days, if anyone sneezes, what was the market? The market was just moving upwards. It did not even pay attention to code or anything. If that news slowly starts moving out, okay, if we understand the vaccine, the inefficiency of the vaccines, for example, I'm just giving you an example, and we see many state bodies started, locking down the states, that's when this news will generalize over the time. Reacting too early for this particular news won't make much sense now. You have to understand, most of us are already gone through COVID. We've gone through multiple cycles of COVID as well. I don't see a lockdown coming very soon, so I don't think it will have a very substantial impact on the equity market.
The next question is from Mr. Satish. Can you please analyze Power Mac project and advise if I can add this in my portfolio?
Sure, if you just share my screen, I'll just search this stock. Okay, so here it's a strong buy currently. Okay, and it's at 84. The good thing is that it's changed from buy to strong buy. Okay, you're asking me if you can add this to your portfolio. The reason that it's a mojo stock, which is highlighted over here, gives more confidence on adding this particular stock in the portfolio. Okay. Now, it's a small cap stock, so you'll have to understand when adding it to your portfolio how much you can add. If you're already invested heavily in the engineering sector, then that's something which you should be aware of. It's a mojo stock, you can go straight forward and buy it. The financial trend also is excellent. Okay, don't worry because the price is higher, I understand, but the financials also moved along with that, and it's an outstanding financial trend. Let me just have a look. Okay, look at this. Since the last 1 month, 18 days it's been added, it's up by 32% already. Whereas the market has been down. So it's moving against the market, it's quite good. It's at an 84 strong buy, you can add it in your portfolio, sir.
The next question is from Mr. Venkata. How to earn 1 crore in market?
So if you're talking about earning 1 crore in market, it depends on a few things. I'll tell you what. Firstly, it depends on the amount of money you're ready to put in the market. So if you're ready to add, let's say, a certain amount in a disciplined way every month or every year, then you'd be able to build a roadmap. Okay, let's assume you make 12 or 15% every year from Sensex or from the market. Then you should actually, there are a lot of SIP or CAGR calculators where you know how much you need to invest every month. And then you might know, okay, after 10 years, if I invest 10,000, whatever, I'll make 1 crore in the market. Now, your journey of making 1 crore can be different from someone else's journey in case he gets a better advisor or he has a better portfolio which has more returns. You have to understand, as this thing compounds, someone might reach faster to his goal of 1 crore versus you who might reach slower. Making 1 crore via trading is, I think utterly impossible. It totally depends on how much money you're making. Making 1 crore in the equity market, being consistent over the long term, is easy but not simple. What I mean by that is you cannot put your money in any stocks and expect it to become 1 crore. There is some learning which goes, there's some understanding for your portfolio, okay, things like that. So it totally depends on the amount of money you're adding, which advisor or which portfolio you're adding it to, what's your risk appetite. And then you can calculate how fast you can reach to that 1 crore amount.
The next question is from Mr. Jigar. Please share views on Triveni Turbine and Acelia.
Sure, I'll just look at Triveni Turbine first. It's a mojo stock, 77 buy rated. I mean, that speaks for itself. It's also an engineering mid-cap company. So, I mean, you could go ahead with this particular stock. I think it became a mojo stock 1 month and 5 days ago. So, it was straightforward, yes. Axelia is still an open stock of the month. Just a disclaimer, I also hold Axelia in my portfolio. Okay, I'm also invested in the stock. The one thing about the stock, it's quite volatile. So, it's high beta in the sense it might move in a very fast movement. If you just share my screen, currently, if you see yesterday, it's up by 5.8%. Okay, and the valuation is fair. Score is at the border of 68. Okay, so at any time it might turn into buy. Now let's look at the returns. Yes, in the past 1 month it's up. Last year it was up by 5.77%. Past 1 year it's up by 35%. Only this year it has seen some cracking down by 14%. But one thing which is slightly worrisome is how the investors are looking at the price movement. Okay, so it has actually cracked down a lot. But you can see the bounce back is also looking substantial. It is an open stock of the month. In case you are invested in it and you're a mojo professional investors, you don't have to be worried. We will come back to you and let you know if you have to exit from Axelia. I'm personally also invested in that particular stock. If you just share my screen, I'm personally also invested in this particular stock. So it's down 12% from November 22 when we've, suggested this stock. If you added this in your portfolio, or even if you don't add it, if you're a professional investor, we will come to you and tell you, please exit Axelia at whatever price and the reasoning for the same. So you can, if you're invested, stay invested. It's currently hold. If you're not invested, don't take a fresh position. Let it turn buy, and then you can make a decision.
So that's it with the Q&A session, Jason.
Okay, thanks a lot. I had kept this session at 6 to 7 instead of 7 to 8 because I realized, I know there's the IPL season which has kicked in. A lot of you all might want to enjoy the match with your friends and family. So that's why we've kept this session at 6 to 7. But if you feel it should be at 7, or if you think 6 to 7 is a good time, you can let me know your thoughts in the comment section below. We do have many events coming up next week as well. We also will be releasing the stock of the month. So the webinars are on the website. Hoping to seeing you all come forward for these events. Goodbye and have a great weekend. Thank you so much.